Hi, good afternoon, everyone, and thank you so much for joining us on this kind of dreary, if you're in DC, afternoon where we're talking about consumer debt as part of the Aspen Institute Financial Security Program's EPIC initiative. This event we are streaming on purpose so we can get all over the country and get everyone engaged, from community groups to city officials to state legislators to fintech companies to financial service firms. It's for all of you. So we really encourage you to engage with us, tweet at us at #AspenEpic throughout the program. We'll be trying to answer your questions offline or through Twitter throughout as we go. And as I mentioned, for the last 6 months, EPIC has taken on the issue of consumer debt. And by this, we mean auto debt, medical debt, credit card debt, student debt, which we've all heard a ton about, and non-loan debt, so fines and fees, not housing debt. And we've been looking really closely at what are the contours of this problem, how do we understand it, who is really being impacted by it, and frankly, what are the consequences for households in our country. So today we're going to have 3 different panels exploring different aspects of consumer debt, and we're excited you're joining us along the ride as we figure out what do we need to do about it in this country. Before we go on into our first panel, I really want to thank our funders and supporters who make Aspen Financial Security Program and EPIC possible. And they are the Ford Foundation, the Kellogg Foundation, the Annie E. Casey Foundation, the JP Morgan Chase Foundation, and the MetLife Foundation. So we are grateful for you for your continued support around EPIC and also on this important issue of consumer debt. So now I want to turn to the first panel, where we are going to discuss what is happening with debt in America right now. How do we understand it? And importantly, not just what does the data tell us, but what is happening inside of families' lives that's important for us to understand. So I am just thrilled to be joined by some of our Aspen EPIC Advisory Group members, Ann Malchata from the Boston Federal Reserve and Megan Kiesel from Livelihood. Thank you so much for being here this afternoon.
Thank you.
So let's get started. We don't have enough time. We could talk about debt for what feels like months, as we have been doing as part of EPIC, but we need to synthesize it for our viewing audience and let them understand what we now know about debt in this country. So I'm going to start with you, Anmal, and tell me, what's happening? I mean, I know that's such a big question, but debt's been increasing in this country, as we know. It's increasing in certain areas. And how is that playing out? Can you just describe to us at a basic level what's happening with consumer debt?
Sure, absolutely. I think the first thing to understand is that consumer debt has increased for everybody across the board over the last, I'd say, especially the last 25, 30 years. We have the data from the Survey of Consumer Finances at the Fed. Debt has increased at every income level. So high income groups, middle class families especially, and at the lower end. That said, the increases have been much larger for low income families than for other families. So for low income families, the amount of debt, the amount of non-housing or consumer debt that non-mortgage debt that low-income families have now is 4 times higher than it was just 30 years ago.
Wow.
So in a really pretty short amount of time, there's been this dramatic shift.
That's right.
And so you've seen debt become really central to family finances. And this is something that middle-class families understand. This is even higher-income families understand as well. But there is a higher debt burden that's being placed on low-income families especially. And as debt becomes an increasingly important part of the financial conditions or the financial lives of families, and especially low-income families, that's a relatively new thing in our society. So that's I think it's a dramatic structural economic shift that would then have important social implications. I mean, we've thought about how deindustrialization, for example, was a really important shift in the economy, and then that had important social implications. So I think that this reliance on debt for basic family finances has important social implications as well.
So debt is a high priority issue, is what I'm hearing you say, and in a way that we haven't seen it or understand it before. Right. You mentioned slicing it by income, that families or households that are lower income, their kind of debt share, how it impacts their families is likely very different.
Yep.
What are other ways to slice it that are useful? Do you look at debt by geography in the country? Do you look at debt by race and ethnicity or gender? Like, what are other ways we need to understand this problem?
Yeah, absolutely. So I think we're very familiar with a lot of research around wealth inequality and racial wealth inequality specifically. So one way of looking at debt is, we think of wealth in terms of assets and whether people own homes or other assets. Debt is just the flip side of positive assets, right? So it's the amount that people owe. So part of racial wealth inequality is debt as well. And so when we look at families that say are in the red, so they have their debt is higher than their total assets, that's about 1 out of 10 families across the United States, a little bit higher actually. But for African American families specifically, it's nearly a quarter of Black families owe more in debt than their total net assets. Yeah, so their net worth is their net wealth is zero, and they're living in the red.
Wow.
And another measure that we have called debt burden. So the amount of income that people are spending on their debt payments, or that that they're for families that for more than 40% of their income goes to debt payments, is an indicator of serious financial distress.
Yeah.
And for low-income families in the United States, across the country, about a quarter of low-income families spend more than 40% of their income
so they
on
have
debt payments.
Smaller income to begin with. 40% is now trapped in debt payments. Leading not much else, right?
Yeah, that's
for any
exactly
kind of mobility aspirations, day-to-day living, what have you.
That's exactly right. And I think that it helps paint this picture of these different worlds of debt. So I think there's this idea that some debt can be good or it can be productive. They can be investments with returns. That can help to generate more wealth.
And I think they can be mobility leveraging.
Right. So I think for some people that is the case, right? That's an experience with debt, and it's credit, right? But for others, at the same time, debt can mean debt traps. So being caught in these debt traps where you're owing money over time and not able to catch up, or just trying to make your payments to get by from month to month, borrowing to really make ends meet. And that, again, this dramatic shift that I described and the increase in debt has happened at the same time we've had large increases in income inequality, weakening of the social safety net through social assistance programs, and so low-income families especially, where there's less resources maybe available through the labor market, through jobs, and then also through social assistance programs or other redistributive policies, they really turn to debt to make ends meet, which is different.
Right, and terrifying. This is a terrifying story that Enmal is painting, and this is a bad segue, but good time to bring Megan in, because you've been working closely with households and families on their whole financial portfolio, but especially looking at debt and credit. And how do these national statistics and what Enmal has shared with us, how is that reflected in families' lives, and what does it really mean?
I never know if it's like reassuring or terrifying when what the economist says is really playing out for those of us that are working directly with families. But I think that everything that I'm saying really does seem like what you can observe on the ground when you're working with families. And I think that in particular, so I think that it's important to remember, by definition, a low and moderate income family is in a tight situation, right? Yeah. So just having enough income to pay their basic expenses every month is really, really difficult, let alone a debt payment, let alone saving for anything for the future. And so when you start adding on some of these problematic debts, it really makes a big difference in their experience, how they're experiencing their finances, and how hopeful they are about what they're going to be able to accomplish. Yes. You see a lot of people come in for counseling around a mortgage or a house, and their hopes are just dashed by these sort of chunks of really problematic debt that you see on their credit report. I think two types of debt that we're seeing, you'll see a lot of now they're really complicated, they're complex and problematic, are auto debt, auto loans, and student loan debt. Yeah. And the thing about them is that once upon a time, these were you were talking like productive debt or useful debt or debt that you sort of understand. You need a car to get to a job to earn money for your family. An auto loan was sort of a cost of doing business. You had a modest, reasonable auto loan so that you could get to your job, and that was reasonable. I don't think we have time to get into the sort of complexities of the subprime auto market right now, but
we will pin that.
Suffice it to say, the way that people are financing auto purchases when they're subprime right now is really problematic, and the products that they're being offered and the way they're being marketed. And so often when you're looking at a credit report, you'll see a $3,000 collections debt for a car the person doesn't even have in their possession anymore. It was repossessed. They don't even have the car anymore, and they still owe this chunk of money. And that's a devastating amount of debt for someone who's barely kind of covering their costs.
Yep.
You'll also see $20,000 or $25,000 auto loan on a $15,000 car because another auto loan was rolled into that auto loan, right? So it's piling up and piling up. They're never going to get out of that, right? That's hugely crippling. And then with student loan debt, we love to read and write the articles where there's 6 figures of student loan debt, and it's amazing and it's crazy. But the most devastating student loan debt you see is generally a low and moderate income consumer who's not making a lot of money in the job market. They attempt to go to school to get a degree. and either because of personal circumstances or something else, they don't finish. Yeah. So they leave with $5,000, $8,000, $20,000 of debt, but they're not worth anymore in the job market, so they're not able to pay that back. And everyone's student loan situation is very unique and special, but there's often situations where consumers they're gonna pay that, they get into default, they can't get out, and now they can't go back to school to finish the degree because they're into default on their student loans, and
so they can't get any more loans to get back to school.
Exactly. So you're just starting to see the debt is becoming the problem. It used to be a tool to solve a problem, and now it is the problem.
I have a question, Megan. I know you've been doing some work with older community members in the Philadelphia area where you are. Debt is, as you said, Anmol, widely spread across incomes in our country. More than 77% of Americans sit on debt of some kind. But for older Americans, it's rising in a way that you didn't think should be there in retirement when you're on a limited income. Mm-hmm. Do you see that play out? And then I wonder, then back to you, how that changes just what we think debt's going to do to our country's economy. I know you're not a macroeconomist, and your words are not the words of the Fed, but I'm just curious, to conject, this is different now. We haven't experienced this kind of debt in the country. Where do you think it's going? And now we're seeing it aging. So what are your thoughts on that?
So I think a lot of our financial services products are sort of designed with this very distinct sort of life cycle in mind, where you sort of buy a home at a certain place and you have a 30-year mortgage and then you've paid it off in a certain amount of time. And that is sort of all getting turned around. So you're seeing people retire who still have mortgage debt, who maybe have mortgage debt and a home equity loan. You're seeing student loans. People are going to school later, they're keeping their loans longer, they're not getting rid of their loans, or they're taking out plus loans for other people. And so the student loans are kind of hanging on longer. And so you absolutely are seeing the debt hang on, into the retirement years. And it's troubling for people because you're working with less and you don't have any opportunity to expand what you have coming in. And so you've got to figure out how to balance all those things.
Yeah. And what do you think about that sort of input into what we've experienced before in the country and how that's going to change what we experience going forward with the impact at the macro level?
Yeah, I think I understand the impact. I think the macro level impact is directly connected to the impacts for the families and the households themselves, right? Yeah. And I think that what we know about debt is that debt is inherently risky, right? So it creates a certain precariousness or a potential for instability for families that hold a lot of debt. And that, debt also it goes with the economic market, right? So if we're in a recession or if it declines on people's ability to keep up with their debt payments, will be tougher, right? And so for anyone who has a lot of debt, there's this inherent riskiness or potential instability that comes with that. So to the extent that it's focused on certain social groups, whether it's by age, by race, by income, there's important questions, I think, to look at there, and I think it's becoming an important policy issue that we should be considering. Yeah. And it's that potential instability that could then, I think, also spread beyond families and affect neighborhoods and communities as well.
And that relates to sort of the geography part of it, right? That there are certain geographies where if you mapped it, and the Urban Institute has done some nice work on this, right? You see kinds of debt and concentrations of debt. Is there, more that you guys have been thinking about there?
Yeah, absolutely. So we're working on this research right now, looking at neighborhood concentration of financial disadvantage. Okay. So in low-income neighborhoods, it's very common that most of the residents would have subprime credit scores. Most of them have been contacted by debt collectors, where that's a common experience. That's how they experience debt. That's an essential part of their financial lives. And then in higher income neighborhoods, these things are almost practically unknown.
Right.
So again, it's this idea that there's these different worlds of the way that debt is experienced in the United States. I think looking forward, it'll be interesting to understand whether living in a neighborhood where most of your neighbors have this sort of financial distress or financial disadvantage, whether that has impacts on other residents in the neighborhood as well, independent of their own situation. So what does it mean to live in a neighborhood where most of your neighbors don't have access to capital, or where most of your neighbors, their only access to loans are through payday lenders and high interest loans. So the things that they're able to do or not do would be limited by that. So your social networks then within your neighborhood are also then limited in terms of the financial resources that are available
just
to
other people you could pull in and help you.
Yeah, I think so. And then it becomes, so in that respect, you can think of it becoming a real barrier to mobility, right? So that it's both. We know that places and neighborhoods reflect a lot of assets or reflect a lot of factors that influence people's outcomes in lives, whether it's health and education things as well. And I think this becomes an important part of it as well, or could. So I think that's an interesting direction that we want to go with some of this work.
Yeah, really looking at from a, sort of like in the foreclosure crisis, right? It was, well, that's just that house down the street, or my neighbor made a bad decision, or they should have never gotten out the loan they did. But slowly but surely we realized, well, if it's all collapsing around us, there's actually a community, city, state, right? We saw the whole economy kind of crush under it. We don't know yet what this debt will do. We've never seen student loan debt this high. Credit card debt is, bouncing back and growing in steam. And, that's an unknown, kind of what it will do. Megan, I'm curious, what do you see about this community impact and really trying to, again, drill down into the lived experience of chronic, being in the red always, but all your neighbors are too, if that's true, if that's playing out with the families you serve.
Yeah, I think it's really interesting. I think you see this family sort of struggling with this identity, or this idea of what they should be doing or what they should be able to accomplish. And I think on the one hand, everyone kind of understands this very traditional, you should go to college and you should get a good job and you should buy a house. And on the other end, there's entire swaths of people who are like, that's no one's speaking to me when they're talking about that. That's not going to be my life. That's not going to be my experience. And I don't really know that we're correcting for that in any way. It seems like all the products that are coming up, or the opportunities that are coming up for families in that situation, tend to be predatory and making it worse for them and not better, rather than trying to solve the problem or sort of monetizing the problem.
So in the few minutes we have left, I want to let you guys get in your sort of deep thoughts. As I mentioned in EPIC, we're at the point of consumer debt, as you guys know, advisory group members, where we've done the synthesis. And in fact, we just published online our new brief that covers kind of all of these topics and more around how to understand this problem of consumer debt. So it's at aspenepic.org and our aspenfsp.org website. So I just want to plug that, because a lot of the data that you've been talking about, less these really important personal experiences, consumer experiences, are in there, but it's backed up kind of in all that data. But we're at this place where we've said, okay, we think we get the problem and the contours of it, and we have a sense of where to prioritize. But where do we go from here with solutions? But there are still unanswered questions, right? There's no amount of research right now, because this is all new and emerging, this kind of debt, that we can know everything. So I'm wondering, from both of your perspectives, and this is how we'll kind of wrap up our panel, what are the things you're most curious about, concerned about, and that, you just think we really have to watch? What's on your radar right now? And we'll kick it off with you, Amal.
Yeah, I think that what's interesting to me is this idea that I mentioned around debt traps, and especially people having this sort of either obstacle to mobility or just obstacles to all sorts of options in life that Megan had mentioned. I think I'd want to understand, how much debt are we talking about, right? So how much debt is sort of creates an obstacle for people to either move out of a low-income neighborhood or to access education or do other things. And it may be the case that, for a low-income family, $5,000, say, that's a lot of money, right? That's a lot that's going to be difficult to save up and pay off over time. At the same time, it's from a social policy perspective, $5,000 is much less than a semester of high school education.
The cost of actually families in debt over time to the country.
Yeah, that's exactly right. And so I think there may be, we can begin to understand what would be necessary to sort of lift people out of those debt traps. And it may be from the social policy side that those bars are actually, they're high enough to keep a family underneath them, but not so high that we couldn't lift them up and create opportunities for people to move past them. And I think that would require certain creativity around policy solutions that we haven't seen before, but it's a different kind of problem. So I think we need to be thinking about that.
I think that's super fascinating, partly because people's debt and their experience is so nuanced to them. So how do we get to some place where we understand some of these numbers, almost like when we got to the $400 in savings mark, right?
Right. And I think that's true. I mean, it is true that the debt is specific to people. At the same time, and we have this idea that it's all very individual choices that lead people to take on these debt and these differences in their preferences or things like that. At the same time, we've seen this happen structurally across the board, and we've seen this over time. We could see the relation to structural factors, the rising income inequality, and the other factors that I had mentioned. So it's not just a matter of individual behavior and individual choices. I think one thing we haven't mentioned at all actually is medical debt, right? That families don't choose to take on a lot of medical debt, but medical debt is one of the leading causes of bankruptcy.
Medical debt happens to you because you need it.
Exactly.
Yeah. So Megan, close us out on what keeps you up at night about consumer debt? I hope really nothing keeps you up at night, but what could keep you up at night about this issue?
I think what I worry about most is that this sort of complexity and nuance that's now being wrapped up in being a consumer of financial services, that, this sort of good debt and bad debt and productive debt, it just doesn't, it's not true anymore. And consumers live a lot of their financial lives by sort of rules of thumb, right? Most people aren't terribly great at finances, but they're like, well, I need a better paying job and a house is a good investment.
Yeah.
And those are still great. But the ways, when you're looking at complex products, and as we were talking about this earlier, when you go to buy a car, you're not just buying a car, you're also buying a financing tool, right? You're buying a loan.
That's
and
right.
They're trying to sell it to you. And so helping consumers figure out how to navigate this more complex financial services world, I'm not sure how we're going to get there. That concerns me.
That's great. Well, there's clearly areas for research and innovation on the policy front and kind of frontier work on the product side. I'm so grateful that you guys were able to harrow the slightly bad weather. I don't know what we're experiencing outside and come here today. This is truly important kind of grounding information for the next two conversations we're going to have. Again, a lot of it is in our primer, which is at aspenepic.org. And now we're going to shift to our next conversation, which will, I think, really pivot nicely off this, which is around the culture, how culture is influencing debt in America right now. So thank you all so much.
Hi, everybody. Welcome back. My name is Tim Ogden. I'm a senior fellow here at the Aspen Institute's Financial Security Program and managing director of the Financial Access Initiative at NYU Wagner. And joining me today is Fred Wary. He's a sociologist at Princeton. And, Fred, where I sit a lot of the time is with economists. And when we talk about issues of consumer finance, it's a lot about the math. But I always enjoy getting to talk to sociologists because money is more than math. It's more than the numbers. There's a moral component. What is the contemporary culture of how we think about debt in this country, and how has that changed?
So one story I like to remind people of is that in the early 1900s, we were facing an opportunity to rethink how we think about debt, especially for working class people. And so there was this guy named Arthur Ham with the Russell Sage Foundation. And one of the things that he said is, in this shift with industrialization, you have all of these working families. They're making, on average, $500 a year. Some of them are sometimes losing their job. They're getting sick. They're having these emergencies, and they need short-term loans. And they're finding themselves getting involved with all this predatory lending. And he called predatory lending sort of the new slavery. And so if you're thinking about early 1900s, after we've come out of Reconstruction, this sort of it resonated a bit. Now the difficulty is that he, at one of these meetings he showed up to down in Savannah, Georgia, he shows up and they're talking about charities and corrections. And here he comes and he says, in fact, this is really important. You should be talking about predatory lending and making sure people have opportunities. And then the discussion turned towards morality. And so there was a sense, and the battle that he was really facing wasn't about, is there a technical fix for how we can structure short-term debt so that it's not debilitating? But it was about, these are not people who are going to the saloon and getting drunk. These are not people who are just hanging out and spending the money frivolously. They have, real concerns. These are moral actors. And so a lot of the debates have pivoted around this question of, are these moral actors? And it's a discussion it's still with us. So every time we talk about sort of debt traps, we sort of move back into this frame of, well, people shouldn't take out loans when they can't afford to take out the loan. There's a sense of a lack of discipline and self-control. There's some literature on self-control that sort of when played out in the popular press, sounds much worse than what the research says it is. But there's a sense that there's something wrong with these folks. How could you put yourself and your family in that kind of jeopardy? Now, when we talk to families about sort of their own sense of their moral compass, ironically, it is the sense of having a moral compass and having obligations to one's family and to one's community that then leads you to take out these kinds of loans. And so one of the difficulties is that sometimes people don't realize that the person who's able to go out and take out a short-term loan is probably doing better than a lot of his or her family members who don't have that capacity to get credit. And they realize that they're getting themselves into trouble, but the question for them is, what was I supposed to do? So as a moral person, I'm not going to have my parents who are living on an inadequate retirement, I will not have them suffer, right? As a parent, I want to make sure that my children can do things like other children when there's a major holiday so that they're not left out. So there's this way in which you're trying to both honor important people in your life, and you're trying to participate in your faith communities, and you're trying to present yourself as, I actually am a moral person. And so for some reason we've had this trouble ascribing morality to poor and working class folks and people of color. There was even sort of, at the turn of the century, debates about funerals. Why are people spending so much money on funerals? This is an extravagance, right? And they're going into debt to do it. And there's a sense that if I can't even send my parent, into the next life with some decency, then what's the use of having a decent, credit history anyway? So if I can't do the things that are really important. So one of the difficulties is that, debt has been a sort of a moral project. And when we're assessing someone's ability to take on debt, we're not just assessing that ability, we're also making judgments about
their character.
About their character. This is it's a moral character question.
Right. And it's not just on the debtor side.
Yeah.
Throughout history, we seem to vacillate between how we view the people who lend.
Yeah.
So I think a lot about internationally, we had this crazy thing happen in the 80s and 90s where people who were lending money went from the worst people on earth to the most celebrated social entrepreneurs.
Yeah.
They were heroes for being willing to lend to the poor. Meanwhile, in the United States, we go through these cycles often where we think, well, the problem is people don't have access to credit. And then some judgments about the people who are lending and the evils, and we saw that most recently with during the Great Recession and the Occupy Wall Street movement, is that the moral character, the moral failing is not on the part of the borrower, it's on the part of the lender, as you mentioned, the reference to slavery. But one of the things, Occupy Wall Street notwithstanding, there hasn't really been a debtors movement in the United States like we've seen in lots of other cultures, at least not since the Great Depression. Why do you think we haven't seen this sort of this mass movement, given what Anmal was sharing about how widespread the increase in debt has been?
So the good thing about debt is that it allows you to assert a sense of autonomy and to engage in self-help. And so when we typically think about social movements, there's usually a sense that your ability to help yourself has sort of been cut off. And so instead you get this thing that allows you to engage in self-help, and it allows you to do it in a way that's pretty invisible. So when most people are helping their family members, they're not going into detail about how they got the money. In fact, they're typically trying to cloak the source of funds. They're trying to say, don't worry, I can take care of this. Or they'll even sort of tell a small little fib so that you don't know that they in fact sort of used the debt instrument that everyone knows they shouldn't have used, right? Because they don't want you to feel guilty. And so one of the difficulties is if you're sort of both proud of being able to take on debt so that you can do something honorable, and you have to cloak the source of that debt in order to remain to sort of perform the honorable self, then it's very difficult to then have a clear external enemy against which everyone else rallies. There's also the difficulty of you internalize these messages that there's kind of something wrong with you if you can't get yourself out of poverty. And so you're being constantly told about sort of there are these great stories of people who made it out. No one then shows you the numbers that say that while they did swim upstream, they in fact were swimming upstream. And so one of the things that we tell people is when we say that there are social forces out there, we're not saying that you don't have choices to make. What we are saying is that there's a constellation of factors that is like a river, and some of these rivers flow very swiftly, and some of them are a little slower. Your demographic group will help us understand sort of which river you're in. But when you're swimming upriver, it takes a lot of energy. And it takes other types of supports and resources, and some people just are going to have a much harder time going up, or they'll get almost up and then they're knocked off. And we can put up some likelihood estimators of to what extent are you likely to sort of swim your way against the tide, because you really are moving against the tide. And so that's the other difficulty, is that if you hear that one person made it, then you sort of think, if anybody makes it, surely I too will.
Even it's a failing of mine.
It has to be my own failing.
It has to be my own failing. Now, you're talking about the different streams that we swim in. I have a personal connection to some of these stories because one of my ancestors is memorialized in everybody's American history textbooks for having lost one of the first major Supreme Court cases. Having to do with interstate commerce and steamship traffic into and out of New York. And fighting that battle left him impoverished. And at the time, New Jersey had debtor's prison. And so he went from being one of the wealthiest people in New Jersey to being imprisoned because he couldn't pay his debts. But because of who he was, New Jersey promptly abolished debtor's prison to get him out. And so he got out of this debtor's prison stream and into a stream that he was more familiar with. Apparently, the ancestors that came after him squandered that too, but he did have a lot less. But another one of these streams that I find particularly fascinating is, personal debt versus business debt, where we have, it seems to me, seen this bifurcation in this idea that it's virtuous for businesses to use bankruptcy law to protect themselves, and that's just smart business, that's savvy. And then in the most recent changes to the personal bankruptcy law, much more emphasis on not fully discharging all of your debts is a moral failing, is a sign of bad character. And that then creates this issue of, if you're in a position to start an LLC or an S Corp and take on debt that way versus take on personal debt, you've got very different streams. Why do you think we think of personal debt versus business debt so differently?
Oh, in this country, to be an entrepreneur is everything. So there's a sense of you take on risk. It's the rugged individualism. You go into the desert 40 days and 40 nights. You are tempted, but you do not succumb. And that's how you get through it. There's a sense of a working of self-discipline. And so long as you're working hard and you're doing all the right things, you're going to make it. Now, this is something that we tend to sort of think about giving people the benefit of the doubt, too. So part of what makes our society work for entrepreneurs is that we think it's great that people take risk. Now, when you're taking a risk, it's very different if you're a member of an in-group versus an out-group, in the way that when small things start to go wrong and indicate that you might be in some trouble, if you're a member of an in-group, then the general judgment is, oh, that might be a fluke, or he or she may get themselves out of it. If you're a member of an out-group, the general perception is when a few things start to look as if they might be going wrong, we should have known. Right. There's something inherent about that particular person and where they're from that should have indicated that this person would not have made it through this particular set of struggles, even though these are struggles that come with taking on risk, and this is what it means to actually be living in the world, that things don't go according to plan, not for any of us. And so one of the difficulties is when we both see the difference in how business debt is treated relative to personal debt, we can also think about some of the differences when we're looking at both business debt and personal debt when there is identity that's involved. It's sort of in-group member, out-group member. And typically we think of entrepreneurship not, our images of entrepreneurship are not sort of full of out-group members, right? So that the sort of the general stories that are told about entrepreneurship and success, unless you're Oprah, it's basically sort of, these are the great capitalists of American society look at the great things they've done, to some extent we've moved a little bit in expanding what that set of narratives is, and we've done better at recognizing the contributions that immigrants make to that set of narratives. But in general, we think debt, not good, especially for working class and poor people and people of color.
I mean, you sort of working class and poor people you mentioned earlier. I just have to brag for a moment. When Fred and I were discussing this earlier, he was mentioning this study, and I actually have a copy of this study from the 1930 that the Russell Sage Foundation commissioned off of that work on working people are taking out these debts, and that's bad. And reading this in the 1930s, what they were doing looked a lot like credit card debt now. It was bridging some liquidity problems, but at the time there was a real moral panic that people were taking on that consumer debt even existed. Now, the idea that someone wouldn't have credit cards is sort of like, what an odd social choice that someone with a job doesn't have a credit card. Did they do something wrong? Have they been denied? So it's weighted with a whole set of different ideas. So our morality shapes what we think is good policy. And Megan and Anmol, in that conversation, it came up: good debt versus bad debt, productive debt versus unproductive debt. But there's there's an underlying moral currency in those conversations that flows under the productive versus unproductive. Is it useful for us to be talking about good debt versus bad debt?
Oh, I love talking about good debt, and in part because some of the ways that bad debt is bad, it's not inherent in the debt itself. It's about some of the decisions we've made about how that debt will be arranged. And so the extent to which we're not only going to say good debt versus bad debt, but then talk about the arrangements that are made to make it bad, that's where we should be moving. And so as we're thinking about sort of the people basically needing a credit card, I have this moment of sort of the what if. In the teens, 20s, and 30s in this country, what if we had decided that there was a better way to deal with people's short-term liquidity needs, and we were doing some of the things that they recommended at the time? Would we sort of not have seen the rise of predatory lending in the way that we have? So there are the reasons that we look to history is to ask these questions about, we actually had a technically sound solution. And there was something else that got in the way of moving towards the technically sound. And so this is one of the reasons why we have to sort of combine both sort of the mathematical understandings of good and bad debt with some of these other sort of moral framings so that we can get a sense of both what's possible, but then what will resonate as possible and as sort of morally reasonable, both for those who are trying to obtain these loans and those who are in a position to provide them.
Well, thank you, Fred. I hope that was as interesting for other people as it was for me. In our next panel, we're going to talk about how some of these good debt, bad debt, and the discharging of debt plays out for families and in policy. So we're going to take a quick break here as we switch out our panelists, and we'll come back to talk about debt and collections and policy.
Okay, great. Welcome back. We've just been talking for the last two panels, if you're just joining us here at the Aspen Epic podcast on consumer debt. about both the state of consumer debt and the stack of consumer debt in America today, and some of the context of how we think about it, how we think about people who have debt in their lives. When is it productive? When is it good? When is it bad? So we're going to switch gears a little bit now and move into a conversation that's a little bit further downstream in the debt process, in the consumer debt process, which is the experience of people who are holding larger amounts of the kind of debt that Anmol talked about earlier, that is potentially non-loan debt, and the debt collection process and how that has changed over time in the U.S. and what additional dimensions of the issue do we have to unpack and talk about with that. So with me today to talk about that is Paul Keel from ProPublica, who's been writing on this issue for the last 5 years pretty intensively, so we have a lot to unpack with you. And also Treasurer Tishara Jones from St. Louis, who's been doing some really innovative stuff to understand both the dimensions of this issue and the role of local government in both potentially driving some of the kinds of debt that people are seeing stay in their record, but also what's the role of solutions in that space. So thank you both for joining us.
Thank you for having
We'll spend
me.
the next 20 minutes kind of trying to unpack this conversation. So, I think, again, we released the primer today. Aspen Epic has been about 6 months now really trying to get into the contours of this issue and what do we understand about the dimensions and the drivers of consumer debt in America today. Certainly some of the trends that we talked about were the rise of non-loan debt as a piece of this, the rise of consumer debt as an overall proportion of the kind of debt that American households own. Paul, you have been working on this issue and trying to understand these dimensions of non-loan debt, unsecured debt, for a while now. So would you start by just saying a little bit more about kind of what started your interest in this area, and what do you think are some of the most interesting things for the American public to be aware of in terms of this role of non-loan debt?
Sure. Well, I was covering, during the foreclosure crisis, I was covering that very frequently in the course of talking to people who were going through that. Oftentimes on the sidelines was this issue with an old credit card loan that had been bought by a debt buyer and had resulted in a lawsuit, and in its own way was another traumatic experience alongside the foreclosure. And so looking into that, I was just astounded that there was virtually no data available in terms of how widespread that was. There's sort of general agreement that it happens quite a bit, but we're talking about lawsuits that happen in local courts for the most part. So there's no national data, and even on a state level, sometimes it's impossible to get data. We're talking about lawsuits over primarily, I think, credit card debt would be the biggest piece, but oftentimes by the company that is not the original lender, a debt buyer that has bought the debt for pennies on the dollar. Medical debt, auto debt after the car has been repossessed and they're going after the deficiency, and sometimes utility debt, as I found in St. Louis. And what I found was that you don't really know what's happening in a given area without looking at the data. So I was often very surprised at the vast differences, even from city to city in the same state, in terms of what entities are pursuing, debtors in higher numbers or not. And so sometimes a local hospital will be very aggressive, another hospital might not be as aggressive. Certain types of car lenders are aggressive, others are not. So, and then there's certain variations, like you have states where there's no wage garnishment at all, such as Texas and the Carolinas and Pennsylvania. And the reasons for that go way back into the past. And so you have a very different experience as a consumer in Texas if you default on your credit card loan as opposed to some other place. And then there are other places with, I think, obviously not intending to set up the situation, where they've made it very cheap to sue. And so you have a vast number of lawsuits. And so one state that I focused on was Nebraska, where you had an extremely large number of lawsuits over medical debt, not always hospital debt, oftentimes doctor bills, lab visits, dentist visits, and because it was so routine, it was just part of the process going to.
So I think what you're saying in some ways is there's not only the initial process of individuals choosing when, for some of the reasons that Fred talked about in the last one, choosing to take on debt is even part of keeping their moral responsibilities to their friends or their family, but that there's actually an entire business now, an ecosystem around how to kind of manage the discharging of that debt in terms of that. And that's fundamentally different now than it was a few years ago. And you talk a little bit about the geographic variation of that, and we'll get into that specifically with you, Tashara, in just a second. But can you paint a picture of what that industry, like what is the process now? So debt collection, debt buying is something that we really didn't think about a lot in quite a big business way, but that actually is part of what you found, right? Is that there is an entire industry now built around this process for, and that disproportionately affects low-income households and households of color. So, could you unpack that a little bit for us?
Sure.
As
So,
well?
I mean, so debt buying as an industry emerged mostly in the 90s. And these were companies that found that there's a lot of credit card loans that had not been collected, and so that was the main source of the debt that they were buying. And then it really exploded in the middle of the 2000s, the use of the courts as sort of a way to collect on these debts. And just, I mean, you can see it in all the data, just a huge spike starting around 2003 or so. And then the other thing that's interesting about this area is that the waves of lawsuits, depending on different types of debts, aren't always traceable to, like a recession or anything like that. There are certain types of debts that are always being collected in very large numbers. And so this debt buyer swell of lawsuits was in a time of economic expansion. It was just that all of a sudden this was a new way to collect debt on a very large scale.
So there's debt buyers, there's increasing implication of the court systems in this process where, I mean, the thing, just to put some numbers on this, 1 in 3 households now has some kind of debt collection on their credit record. And in some geographies, the court system, what's the load of cases that are actually tied up around debt collection now?
Well, we're talking in the tens of thousands. So Nebraska, it was like 60,000 lawsuits in a year in a state of 2 million people. It was, I mean, the crazy thing is I can't give you a national number, so I've done my best to get that number. So we had 80.
So it's really one of those places when we say, like, when we move in EPIC toward both understanding the problem and trying to figure out solutions, what we're saying is there's a big role here to understand and unpack at the local and state level, largely because we actually don't have an ability to get our hands around this issue at a national level because there's so much variation.
Right.
Let's pull you back into this in a minute, but Tashara, let me come to you, Treasurer Jones, to localize this conversation in terms of what you have seen in St. Louis, both in your role as treasurer, but then just in your role overall of, being at the heart of what's been happening around fines and fees and the role of local government as part of this non-loan debt.
Right. So in St. Louis, about 4 years ago, the world finally saw what we had been seeing on the local level for years, which is the municipal courts had been using African Americans and minorities as ATMs to fund their local governments, and through through the collection of fines and fees, through traffic stops. So, someone gets stopped for a traffic violation, gets a ticket, doesn't pay that ticket, doesn't show up to court, gets a warrant, then they stop that person again, take that person to jail, and the warrants by then have ballooned into hundreds of dollars of debt that they can't afford. That person goes to jail, loses their license, loses their car, and their life just spirals out of control. This had been happening for years in our area, and unfortunately it took the death of Mike Brown for the entire world to see what we were going through on the local level. And some of the things that that I have noticed just in my office as treasurer, which is probably the most unique elected official in the country, in that I'm the parking supervisor but also the treasurer for the city of St. Louis. I opened an office of financial empowerment about 4 years ago, just before the death of Mike Brown. And I have noticed that I can't do financial empowerment on one end and then also be the parking ticket czar on the other end. So I'm trying to marry those two to see how we can use our financial empowerment services to help those who have fallen into large amounts of debt related to parking tickets.
Right, and there's I think a couple of reasons why the problem compounds for low-income households, and particularly for households of color, right? So we certainly, with Ann Mall earlier on today, was talking about the rise in consumer debt, even though the overall amount for low-income households is still smaller than it is for other households, but that the debt burden has been rising as a percentage for those households. With communities of color and Black and brown families, this is something, Paul, you've talked about a little bit too. There is a way that the pursuit, both the kind of levying of fines and fees happens disproportionately in that space, but also the way that representation happens or doesn't in the court process also disproportionately affects households of color. So, I mean, could you say a little bit about what you understand, a little bit more about kind of how is the disproportionality kind of being addressed and identified at the local level?
Well, I think
and then
one
how
of
does
the things that we
connect in?
also discovered is St. Louis is with the fifth most segregated city in the country. So we had this hyper segregation and fragmentation when it comes to black and brown neighborhoods, and those neighborhoods were also over policed, and most likely you were most likely to get stopped in one of those neighborhoods, and most likely to get charged for a traffic ticket, and then the spiral starts and then it begins. So that's the unfortunate place that we find ourselves in, and you can look around the country and with other cities like Detroit and other cities that are on that list of most segregated cities, where you find hyper segregation, you also find these other problems.
Mm-hmm. And you're saying as well, Paul, that it's not even just in places with hyper segregation. You're seeing relatively homogenous populations in some places where you're still getting disproportionate impact in the debt collection process on households of color.
Right. What we found is there's more suits in some localities than others for these, kind of other reasons. But we found racial disparities everywhere we looked. So there's sort of a base level of this sort of activity in terms of the number of suits being filed, but it's going to impact black communities more than the white communities, what we found in different places. And that, I think, goes back to some of the same issues with bail or parking tickets leading to a driver's license suspension, is a lack of greater financial vulnerability or a lack of the assets to prevent sort of the snowballing effect of a bad thing that happens. You lose your job, or there's an expense you weren't expecting, and all of a sudden you have to come up with that money. If you can't come up with it, then there's a series of bad outcomes that can snowball, and there can be a domino effect that lasts months or even years.
Let me switch gears toward how do you solve this problem? So in some ways, the variation in the level of court engagement is different around the country, which suggests that there is a state and local policy regard to this. You have some really interesting data about the when wage garnishment laws even got on the books, and that was, I think, way back in 1968.
Right.
So can you say a little bit about when there are policies in place that could have maybe unintentionally or not drawn us forward or into the problems that we have today? Where does that start from, and what are some of the solutions that you see being promising?
Sure. So the only time, to my knowledge, that anyone's ever taken a run at this in the national level was the late 1960s, and the problem there was that there were some states, and this is all state law that kind of sets the basis for this, but there was no federal regulation or limit on garnishment levels, and so what you had in some states was 100% garnishment. So their entire paycheck was being taken by a creditor, obviously leading to problems and to bankruptcy and that sort of thing. And so out of the legislative process came this number of 25%. And it was just somewhere in between 100 and 0. And I've never talked to anyone, even in the collections industry, who thinks that it's a reasonable amount of money to take from someone's paycheck. We're talking about, again, non-core type of lending. We're not talking about a mortgage. We're not talking about housing. We're talking about a credit card bill they didn't pay from 5 years ago. All of a sudden, a quarter of their paycheck is going towards that.
And that's if it goes through wage garnishment, right?
Right.
If it goes directly to a bank account, which
Right.
is another option,
Yes.
there's no limit on what.
There's no limit on that.
They
So
could take.
because this is the late 1960s legislation, people weren't having their paychecks automatically deposited in their bank accounts. So you have an insane situation where, if they happen to go to your employer to garnish your paycheck, they can only take 25%. But if they go to your bank, they can take all of it. So this is all state law, and there's a lot of variation in terms of how much of a wage is being taken. There's generally very little protection on bank accounts. So in terms of a state that has made reforms that I think could be some sort of a model, is New York in the last several years put an automatic protection on bank accounts. In other words, to say that if you have under around $2,000 in your bank account, then it's not being taken,
touch it.
which I think makes an enormous difference. The one time I was able to look at bank account garnishment data, the typical garnishment was like $300 or something like that. So, and then zeroing out people's accounts often. And the pernicious effect of that is that people often will avoid banks because of that. And oftentimes this is a population that you want to be using banks. It's supposedly like a major policy. Yeah.
Right. So Tashara, you hear information like this, and you're a woman with a plan when it comes to financial empowerment in the city of St. Louis. You've also both taken from other cities that you've learned from, and now other cities are inspired by what you're doing. So when you hear about this issue and the leeway for leadership, what gets you excited, and what would you say to other state and local lawmakers and policymakers about the opportunities here to get engaged and think about these issues?
Yeah, I think there's often a myth about, is this an area where, government is usually the problem versus can government be the solution? And I think that, yes, we can offer solutions. And one of the things we've done in the Treasurer's Office is take a look at, where we sit between financial empowerment and also being the parking supervisor, the parking ticket lady, right? So we are in the process of putting together a program for people to pay off their parking debt and decrease it over time by taking financial empowerment courses. So they would come out better on the other end with tools that they need to budget and make better financial choices, but also getting rid of this debt by just doing a few things, taking some personal responsibility. The other thing, I think that mayors could be looking at is this concept of ending cash bail. Because 90% of the people in jail in St. Louis right now in our city jails are awaiting trial and can't afford bail to get out. Right. But it costs us more to keep them in jail than it would if they were out to be able to continue to live their lives, to be
incurring debt
citizens.
while they're in jail too, right? They're being
debt.
charged for that.
Right. They're being charged for that, but they're also, being charged for, their lives. So they're losing their car, they're losing their home, they're, whatever debt they had because they lost their job is starting to pile up. So what are the alternative sentencing that they can look at while they're awaiting trial that also saves the city money and also saves that person a lot of grief?
Parking, justice reform, and I think the other one that we've mentioned before, and National League of Cities have been looking at, is also utilities, right?
Yes,
which is one of the other big
the Lift Up
there.
program through the National League of Cities that takes a look at utilities debt. Just about every city has a utility that they control, and they can use that same program.
Great. Well, we're going to close up here. This is certainly one of those areas when we go through the EPIC process, and we've kind of like named the landscape of the issue. We'll be moving into this kind of solutions phase. So we'll be having a lot more in-depth conversation about what it would look like to solve this problem at the same level of scale that we are understanding the scale of the problem at the time. So we're excited that you all are both heavily implicated in ongoing parts of the EPIC process. Final thoughts from either one of you around maybe from different perspectives, where has this led you in terms of the kind of feedback you've gotten as you've been the journalism you've been doing on this, and the kind of public response, and any kind of things that people just don't believe to be true that you write about, or the things that are most shocking? And for you, I think, Tashara, where do you go next with these issues of kind of understanding where debt fits into the level of priority for local government action?
So I after working a lot on this issue and garnishment and talking to people, oftentimes in the background was, well, bankruptcy is a solution to this. That's the one thing that can definitely shut down a garnishment. And so I did a series of stories about that, because some of the same discussions earlier about the morality of debt are bound up with this notion of declaring bankruptcy. And we have kind of a crazy dialogue around bankruptcy where we've talked about the vast numbers of people who are actually behind on debts. Millions of people don't pay their debts. They just sort of go away over time because maybe and then the people who actually take a step and declare bankruptcy and have those debts discharged are stigmatized in a way that doesn't make sense when you step back and look at how people are dealing with their debts. And so it was interesting that there's these sort of moral questions extend through the process, and they really do affect people's decision making.
Yeah. So we'll look for more of that. And then for you, kind of where does this fit along the things that deserve your time and attention, and the time and attention of other leaders in the country.
Well, I'd like everybody to take a look at what Jose Cisneros is doing with his financial justice project. They are seriously taking
In San Francisco?
in San Francisco to take a look at fines and fees, how they've been levied in the past, how that affects people of color and poor people, and what they can do to change those. And they've been making some really quick wins as they've started to take a look at this. And I'm really excited about the research that's going to come out of that project.
We will follow up with that as well. I want to thank both of you for time today. I also want to just remind everybody here that the primer, our consumer debt primer, was released today. So, in-depth scan of this entire issue is theirs in 31 short, pithy pages for you to take a look at, and that's just the first of many publications and consumer research pieces we'll be putting out. I want to also just reemphasize what Joanna said at the beginning of this, that the whole idea of not just doing the right research and finding the right angles on a story, but actually putting people in conversation with one another to understand collectively what we understand about the problem and what we can do about the problem is part of what EPIC's goal is. That's only possible because of the funders who have believed in and supported this work. So thank you again to the Ford Foundation, the W.K. Kellogg Foundation, J.P. Morgan Chase Foundation, MetLife Foundation, and the Annie E. Casey Foundation for all of the support and encouragement to take EPIC into a second cycle. Thanks also to the Aspen Institute team and the advisory board for EPIC. And this is just the first of many ongoing conversations we'll be having over the next year as we move towards solving and accelerating solutions to consumer debt. Thank you.
Thank you.